So this chart illustrates the S&P 500 movement in 2020, and this highlights the perfect transition between bull and bear markets. Hey everybody, welcome back to Whiteboard Finance. My name is Marco, and I'm here to help you master your money and build your wealth. In today's video, I want to talk about a critical topic for all investors, okay? Especially at the time of this recording. We're going to be talking about the difference between a bear market and a market correction, okay? There seems to be a little bit of confusion that I've seen online, so I wanted to make a video about this. You guys have to realize that the US stock market has been going up for decades, okay? It's delivered an average annual return of about 11%. So if you're invested in stocks, you've probably seen the market go up, down. You've probably heard the phrases correction, bear market, things like that. They've been thrown around, okay? But most importantly, how should you react when you hear these things and when they happen? So let's get into it. Okay, so let's talk about a correction first. So market corrections are when stocks, they drop 10 to 20% off their recent highs. Okay, this might sound scary. It sounds like a huge number. Imagine if you had $10,000 invested and it drops $1,000 to $2,000. It's 10 to 20%. So it's actually pretty normal. So since the year 2000, there have been 10 market corrections. On average, market corrections last about 3 to 4 months before recovering. So why do these things even happen? Why does the market correct? So sometimes stocks get a little bit too expensive, aka overvalued. Typically, you're hearing a lot of momentum. You're hearing a lot of stuff online, whether it's forums, whether it's X or Twitter, whether it's social media, whether it's YouTube. Sometimes individual stocks or markets in general get overvalued. You feel like you're pressured to invest. Everyone's doing it. You have to do it too, right? Same with this. Sometimes there's bad economic news. Okay, sometimes these investors get spooked, obviously with tariff headlines and different things that are being implemented right now. Policy-wise, investors do get spooked. Also, the third reason is that investors just wanted to take some profits. We are seeing record highs. S&P 500 was hitting record highs. Same with other stocks. So people just wanted to shave some cream off the top. So whatever the reason, corrections are often seen as healthy for the market. They help bring back prices to reality. And if you're a long-term investor, corrections can actually be buying opportunities, which we've seen over the past couple weeks at the time of this recording. So think of it as stocks going on sale. Okay, so a bear market is a little bit more serious, okay? This is when stock prices fall 20% or more from their highs. Bear markets last longer than corrections. On average, they last about 9.5 months. So bear markets are different because they usually happen when investors lose confidence in the economy, and this could be due to a recession. This is 2 consecutive quarters of negative GDP growth. You have high inflation or high interest rates, or a financial crisis, or you have some kind of major global event. Let's take 2020, for example. So a bear market ends when the stock market closes at a new record high, but here's the tricky part. You only know you are in a bear market after it's over, okay? So let's take the 2020 bear market, for example. It only lasted 1 month. The shortest bear market in history. But during that time, the stock market plunged over 30% in just weeks, and then before most people realized that, the market shot back up to all-time highs. Let's take a look at that chart and break it down right now. So this chart illustrates the S&P 500 movement in 2020, and this highlights the perfect transition between bull and bear markets. So bull markets before the drop, the S&P 500 reached a record high on February 19th, 2020. This was the peak before a rapid decline. Now, after February 19th, the market experienced a sharp decline, entering a bear market. The bottom was reached on March 23rd, 2020, with the S&P 500 closing 34% below its February high. This was one of the fastest bear market crashes in history, driven by, we all know what, Cerveza, right? The bull market recovery, let's take a look at this. So following the March low, the S&P 500 began a strong rebound. So on August 18th, the S&P 500 closed at a new high, marking the official end of the bear market and the start of a new bull market. So what are some takeaways from this? This is real. This happened, okay? This is only 5 years ago, even though it feels like just yesterday. So the 2020 bear market lasted only about a month. And despite a massive drop, the market fully recovered within 5 months. This shows the resilience of the stock market and a little bit of unprecedented money printing. But lessons for investors. Bear markets don't last forever, okay? Selling at the bottom, which is panic selling, can be costly. So staying invested during these downturns can lead to significant gains during recoveries. Okay, so here's the million-dollar question. Do market corrections always lead to bear markets? Okay, the answer is no. So since 1975, there have been 27 corrections, okay? And only 6 of those turned into bear markets. That means that most of the time, a correction is just a short-term dip, okay? This is not the start of a long-term downturn. So if you panic sold during a correction, you might be making a huge mistake by locking in those losses instead of staying invested for the recovery, okay? So our takeaways here are don't panic sell and don't make that huge mistake. Okay, so finally, what happens if the stock market drops too fast? Sometimes stock market prices drop so fast that trading gets halted automatically. These are called circuit breakers, and they help calm the market when there's extreme panic selling. So there's 3 levels of circuit breakers, okay? Level 1 is when the market drops 7%. Trading pauses for 15 minutes. Level 2 is when it drops 13%, another 15-minute pause, and then level 3 is 20%. Trading is shut down for the rest of the day. These circuit breakers are triggered multiple times. If you remember back in March 2020, or if you remember GameStop and a bunch of stocks being halted, it was crazy. They basically paused the casino, okay? The idea is to give investors time to think rather than panic sell. So is it a free market? I don't know. Let me know down in the comments below, but these things do exist, and that's when it drops too fast. Okay, so as always, let's get into my thoughts at the end of the video. So here are my thoughts. So what's the key takeaways? Corrections happen often, and they usually recover in a few months, okay? Bear markets are deeper declines, but they don't last forever. Panicking and selling at the bottom is one of the worst things you can do, so do not panic sell. So if you're a long-term investor, these dips are actually buying opportunities to buy great stocks at a discount, or you can just buy an index fund, right? You don't have to buy individual stocks. But remember, the stock market has been rising for decades with an average return of about 11%. So patience and discipline are the key to long-term success. As always, if you found this video helpful, do me a favor, hit the like button, press the bell for notifications, subscribe if you haven't already, and please share this content. It takes a lot of work and effort to make. Thank you so much, and as always, have a prosperous day. Hey, don't panic. Japan only lasted 30 years. 30 years since Japan's stock market peaked, climb back continues. Even after the 1929 U.S. stock market crash, which triggered the Great Depression, share prices regained their pre-collapse highs in 25 years. For Japan, the struggle has been harder. 30 years on from its all-time high, the Nikkei stock average is still languishing about 40% below the peak of 38,915, scaled on December 29, 1989. The Japanese stock market's uphill climb to regain lost ground is the longest in the history of any major economy.